Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mina and I want to talk about what should your profit margin be, and then we want to share 5 ways to actually improve it. Now, what should your profit margin be? It's a great question, and it's going to depend on the type of industry that you're in and the type of product or service that you're offering. As high as possible is probably one answer, but that's an obvious one. I think your profit margin should be, whatever compensates you for the risk associated with doing business. Profit margin that keeps your business sustainable, so you can be around 10 years from now to help your customers and clients and so forth. And then whatever else it needs to be in order to help you achieve your lifestyle and financial goals. So there's no point pursuing a business with a 5% profit margin if you're going to always struggle to buy a home and invest in super and build wealth and all those sorts of things. So it doesn't really answer the question, but I think most small businesses should be aiming for a profit margin of somewhere between 20 and 40%, which is a big range, I acknowledge. What do you think, Mina?
Like you said, it really depends on the industry. I know, for example, logistic industries or, sort of your larger retail industries that work off volume, they tend to work off a much lower margins because they rely on the volume component rather than the sort of lower volume but higher margin sort of model.
Yeah, and that's true, and that's certainly centric to industry. I mean, you look at supermarket margins, for example, they're relatively small. Again, I think you've got to make sure that you're being compensated for the risk that you're taking. So whilst you might have a smaller margin, arguably, your risk is somewhat diversified because you're selling 10,000 units a day, for example. So, if you stop selling units in one category, you're probably not going to feel it too much. Whereas if you're selling cars in a car yard, your turnover is much smaller. So in a way, it reduces your risk. Conversely, those sorts of businesses tend to have high stock levels as well. So it depends on stock turnover. So you've got to give consideration to your industry. But also, I think, if you're going to be stuck in a business with a 5% margin, it's never really going to generate enough profit for you to be able to achieve your lifestyle goals. That's probably not the answer for most people. The answer could be find out what the industry acceptable margin is and then try and aim for something towards the higher end of that range. I think if you can build a business that has good perceived value, that is well run, and certainly this is a role for your holistic accountant to make sure you've got the information to run it well, then the goal should be, I want to be at the top end of the range in terms of industry profit margins. So we thought we'd talk about 5 ways we could go about increasing your margin.
So the first is pricing. Funny enough, it's a conversation I've had with a lot of clients recently, and it's really was instigated by the fact that obviously we've all experienced the cost of inflation at the moment, or the cost of increased overheads, whether it be sort of employment wages or the actual cost of goods sold. And funny enough, a lot of businesses haven't actually reviewed their pricing structure as a result of it. They're still sort of maintaining prices and their bottom line is really being hurt because, you talk about, 3 or 4, 5% CPI increases on rent and add to that 7% increases on wages, and all these little sort of percentage increases on certain components really add up. And before you know it, will have a big impact on your bottom line. So it really comes down to how often are you reviewing your pricing? And more often than not, a lot of businesses aren't reviewing their pricing. They're still trying to either compete on price and reduce their margin just to remain competitive in the industry. Whereas I can guarantee you a lot of your competitors are probably reviewing their pricing anyway.
I'm going to think about, are you a price maker or price taker? If you're a price taker, that is, the price is really set in the industry, then it's really upon you to try and increase perceived value if possible, and therefore you can potentially charge a premium compared to your industry. If you're a price maker, that's a lot easier, right? You can increase prices, probably won't have a big impact on volume of sales in terms of unit volume of sales, but the benefit is it drops to the bottom line. If you increase your prices to generate another $100,000 in the next 12 months, that means your profit will increase by $100,000. It's really powerful strategy to make sure you're extracting fair value from your business. And of course, there's no point charging your customer $100 if they're willing and very happy to pay $120. Getting that pricing decision is really critical. And if you want to learn more, we've discussed it in detail in the first season of this podcast back in April 2021, episode 5. So you can have a look for that one. Apart from revenue, which is really pricing, the next big category obviously is expenses that contributes towards determining your profit. And we would recommend a periodical review of your expenses, probably every 6 to 12 months, which is really just a case of looking or getting a rundown of your expenses, your profit and loss statement, and having a look at the change in the expense from year to year. And you might want to build a bit of a trend there, maybe have a look at the last 2 or 3 or 4 years, because sometimes prices just gradually increase. You don't really notice it until you go back and really have a look at the longer term trend. And then you want to look at that expense as a percentage of revenue. So again, just making sure those margins aren't creeping.
And I think it's really important when you're looking at your inventory management to actually review your actual product line as well, because if you're sitting on a lot of stock that doesn't move very often, it actually costs you money to keep that on hand. So it's dead money just sitting on your shelf. So sometimes it's better to contract your product line just so you can use that money in better places in the business.
Yeah, and the cost side of your business is something certainly that your information system should spit out. So that is your business information systems, P&Ls, those sorts of things. You should have a system that gives you all that data that's really easy to track. And if expenses are a bit of a moving feast in your business, so if your margins are a little bit tighter, you might want to do this analysis more often. Whereas if your expenses are relatively fixed, you might only do it sort of once a year. The third idea is employment costs. So, it really comes down to productivity per dollar hour that you spend on employing people and making sure that you're getting or maximizing the productivity from that. And the first question we would typically encourage people to ask is, would you enthusiastically rehire everyone on your team? It's a great question to continually ask yourself, because obviously these things can change from month to month or year to year. And you want the answer to be yes, and the key thing here is enthusiastically rehire, because sometimes when we ask the question, people think, oh yeah, I'd probably rehire them just because they just couldn't be bothered with the pain of having to let that staff member go and then find a replacement. Of course, we all know that's costly, timely and frustrating and all those sorts of things. But really, it's a bit of short-term pain for long-term gain, because if we have the right people sitting in the right seats, it's always going to be great. The next thing you can do if you want to improve productivity is ask what training you can give your staff member or members. Again, you want to have good insight onto, the systems and processes they're following. But if you're employing people and not to train them and not to give them regular training, ultimately that's going to cost you in terms of productivity.
The third thing to look at within the employment subheading is basically, do you have the right tools and the software? I know it's something that we really actively do within our business, is we're constantly questioning ourselves, what can we implement to help improve efficiencies in our business, whether it be software or training, like Stuart said. And it's all about collaboration as well. I really recommend that you actually collaborate with your employees, empower them to actually come up with ideas that can either improve efficiencies, whether it be through software or tools, or other sort of metrics in your business to help you or get more out of your employees going forward. And the last thing to consider is, and it's probably not a very popular topic, is outsourcing. The solution is out there. There's a lot of businesses that do it, and if it's done right, it could significantly reduce your overall employee costs.
We all know that the cost of customer acquisition is really one of the major challenges in most businesses. If we had an endless supply of customers, of course, it solves a lot of problems. It's not a problemless business, but it solves a lot of problems in terms of growing a business. So the fourth thing you can think about is, getting a greater share of wallet or greater loyalty from your customers. So that is, what else can you sell them, or can you sell them more of the same products more often? And it's a great way to think about it, because as I said, if you've got that one customer, you built that relationship with them, that's 80% of the work done. Then it's really about, I like this idea of don't sell stuff to people, help them buy. And no one really wants to be sold to. So, if you can get to know your customers, then you can help them buy more product from you because you're obviously solving a problem for them or giving them something they really desire. And so let me tell you a quick story about a hospitality business in Melbourne, in Fitzroy. There's a really great restaurant called Cutler Co, and it's been there in Fitzroy for a long period of time. Next door to that is a more casual dining restaurant called Marian Wine Bar. And then next door to that is a cafe, sort of pre-prepared food store. It's not a very good description, but it's called Morning Market. And they're three businesses all adjoining, all owned by the same owner. And so that owner's worked out that, the same people that come to Cutler Co, which is a fine dining restaurant, it's expensive. You might only go there a couple of times a year, maybe more often, I don't know. But you're not going there every day. You probably go casual dining a lot more often than you'll go fine dining, and probably people buy a takeaway coffee on most days. And so that business has worked out in terms of share of wallet. They've got everything to sell you. And it's fantastic. It's great produce, it's great service, it's premium pricing, so that they're running a really sustainable, great profitable business. But I thought it was a really good story to share because I think they've absolutely nailed the share of wallet customer loyalty story. And if you can think sort of broader like that in terms of what else can you help your clients with and customers that you've worked hard to first find and then secondly build a relationship with, great way to increase your profit margin.
And lastly is to get financial insights by actually department, by product, by region. It's amazing how many businesses sort of just combine all that data into one and they just look at top line sales or direct costs associated with sales without knowing where their actual, profitable sort of regions lie or where their profitable services or products lie. So, it's really important to implement a system that gives you that right tracking to basically look at regions, look at new products or services, look at particular customer sort of profiles, whether it be 20 to 40 for example, or 40 to 60 and so forth. It's really important to sort of get that data so that you can not only actively market to those people but know where your true products and services that attract the biggest profit.
So there you go, there's 5 stories. Just to recap, think about pricing, make sure your prices are really up to date and reflect fair value for what you're offering. Review costs and inventory management. Think about employee productivity, so it's really your headcount and productivity. Share of wallet and customer loyalty, so expand your offering to your existing customers. And then 5th, make sure you've got really good financial insight so that you can really focus on and double down on, the most profitable sectors of your business. Anyway, that's a bit of food for thought. And until next week, bye for now.